what is the other world of tax liens and tax deeds, and why does it even exist?
Lots to unpack there, but I think maybe I'll start at the very beginning.
Mhm.
And there is, I say, a component of I'll call traditional real estate, approach to it, where you're buying, the property. It's just a different, auction than people I think are used to searching out. But maybe we'll go back to the very beginning and talk about why this industry even exists, and it's an
Mhm.
industry that is a pretty substantial size. There's over $9 billion a year sold of tax liens and tax deeds, and I'll dive into what I mean by those two terms here shortly. But when I got started in this space, I didn't know anything about it, and I think still today most people don't know about it because most people pay their property taxes, or most people have a mortgage on their home, right? And built into that mortgage payment is a portion that gets allocated to paying your property taxes, and so nobody even realizes what happens or even thinks about what happens if I don't pay my property taxes. And that's really what this whole mechanism was invented long ago, way before I was in the space.
Most investors are looking at same deals on the same platforms, competing with same people. And then they wonder why returns feel compressed, why opportunities feel limited, and why it's getting harder to find a real edge in the market. And what if the best deals were not meant to be found where everyone else is looking? What if there's an entire segment of real estate that operates quietly, where information, not competition, determines who wins? I'm Winky Loomba, your host, and today we are stepping into a part of market that most investors do not fully understand, but the ones who do often build wealth very differently. Joining me today is Brian Seidensticker, a founder partner of LastPartners and the founder and CEO of Tax Sales Resources. With a background in systems engineering and deep expertise in tax lien and tax deed investing, Brian has been at the forefront of transforming how investors access and analyze these opportunities. Today, we're going to be talking about hidden real estate deals most investors miss, where they are, how they work, and what it takes to approach them intelligently. Brian, welcome to the Wealth Wife Show. I'm super excited to have you with me today.
Well, thanks, Vinky. Thanks for having me on. Excited to be here. You mentioned most people don't understand, and I think I've been in the space for 18 years now, and sometimes I feel like I don't fully understand it either. So it'll be fun to talk about it.
I know I'm looking forward to learn from your experience. So let's start it very simple. Most people think of real estate investing in terms of just buying properties, rentals, syndication, fix flip, like we were talking before the recording. So
Mhm.
what is the other world of tax liens and tax deeds, and why does it even exist?
Lots to unpack there, but I think maybe I'll start at the very beginning.
Mhm.
And there is, I say, a component of I'll call traditional real estate, approach to it, where you're buying, the property. It's just a different, auction than people I think are used to searching out. But maybe we'll go back to the very beginning and talk about why this industry even exists, and it's an
Mhm.
industry that is a pretty substantial size. There's over $9 billion a year sold of tax liens and tax deeds, and I'll dive into what I mean by those two terms here shortly. But when I got started in this space, I didn't know anything about it, and I think still today most people don't know about it because most people pay their property taxes, or most people have a mortgage on their home, right? And built into that mortgage payment is a portion that gets allocated to paying your property taxes, and so nobody even realizes what happens or even thinks about what happens if I don't pay my property taxes. And that's really what this whole mechanism was invented long ago, way before I was in the space. I still don't know exactly when it was invented, but it was. put in place really to help the enforcement or to ensure that people do pay their property taxes. Because what happens if you don't, right? I think it's like what is that dollar? What are those dollars used for by the county? Typically the county, right? Well, that's used to pay the teachers, pay the firemen, the policemen, right? Pave the roads. That
Mm-hmm.
money is used for a lot of great things. And so if one person doesn't pay their property taxes, not a big deal. But if tens of thousands of people don't pay their property
Okay.
taxes, and
Mhm.
the largest sale typically annually is New York City, and we're talking to the tune of $250 million that goes unpaid on an annual basis. That's a lot of money that the county could put to good use. And so this whole tax lien tax deed mechanism was built to help those counties balance their budget. And so the first half of the sequence or process is the tax lien process. And really what it is a deal that's made between the county or the jurisdiction, sometimes it's the city level, not always the county, but the county and a private investor. And basically the deal is this, right? The county says, I have $1,000 of unpaid property taxes. The private investor says, okay, I have $1,000 that I can technically give you, but what do I get in return? And the county says, well, I can do two things. I can when and the likelihood that the property owner does pay the property taxes, and the vast majority do, then whatever that interest that has been accruing or that penalty, right, for paying late, right? And so most folks are used to, if I pay late, I pay more, right? Well, that addition that they'll pay, instead of me keeping that as the county, I'll give that to you as the private investor. That's part one. And then part two is I will put a lien on that property. And so if in the case the property owner never pays their property taxes, you can foreclose on that property. And that lien will actually have superiority in position compared to a mortgage. And so you're in a very good position if the property owner never pays their property taxes. And so the first part is a lien, right? You're not actually buying the real estate itself. You're buying an interest in the property. You're earning a rate of return. You don't necessarily know when you're going to get paid, because the property owner could pay their taxes tomorrow. They could pay it 2 years down the road, right? You don't necessarily know when, but you're
Exactly.
likely going to get paid at some point. And then part two, right, is if they never pay their property taxes, right, the property owner never pays, or more likely than not, it's an abandoned property. Nobody comes forward to pay the property taxes, and that is when the lien holder, right, the investor, can say, okay, I'm going to start the foreclosure on it. And that culminates, it's a legal process, just like a mortgage foreclosure. It culminates in the tax deed auction. And the tax deed auction is the sale of the real estate itself. And so the investors that come to that auction are interested in buying the property, right? They're not interested in buying a micro mortgage or a lien, right, and earning an interest. They're actually interested in buying the property, and then all of the right, full well, all the fun and not so much fun that comes along with real estate ownership. And that's the tax deed side. So that's the difference, right? Or where in the story, the difference between tax liens and tax deeds.
So, but let me ask you this question. So, how long these deals are, like from the time perspective, right? So if somebody missed paying the taxes, or there's a lien on the property, maybe day one, today, month one.
Right.
So how many times can they miss till it hits the auction? Or how many times as a tax lien buyer, how many times you have to pay for somebody else's taxes?
Before you can start the
Yeah, before you think, okay, you can buy the deed now,
yeah, I think
or
the
have the
hard part.
option to buy the deed.
That's exactly the right question, and I think the natural first question. The hard part, and why I mentioned earlier, sometimes I feel like I have been in this space for 18 years, I don't know anything still, is it varies from state to state, right? There are some states, and what I described is, I'll say, the generic process, and many states use that generic process and have both of those. There are states that skip selling the lien, and the county takes on the burden of an unpaid property taxes, and then years later, right, and in almost all cases it's years later, they will sell the property, right? And in some cases that can be up to 5 years later, right, that that somebody can be delinquent, and by that time, right, if it's an abandoned property, that property's in very rough shape. And there's other states. I think the quickest timeline is I think Texas, where if you're 6 months delinquent, they'll sell what's called a redeemable deed. Right now, we're getting into the nitty gritty details. And so it's a very quick process, but then there's a period of time after that sale occurs that the previous owner can come and redeem that deed that was sold. I probably answered a question and created 10 questions with that redeemable
More.
deed curveball there, but the short answer to your question, Vinka, is it varies, right, from 6 months to like 7 years in some cases, where how long those taxes can be delinquent before it converts into a deed scenario.
And the new owner, I would say the tax lien owner who's paying for somebody else's taxes, how many payments they have to make? I mean, they keep on paying that, like if it's not going to be delinquent for 6 months down the road or 5 years down the road, or is this like the one-time thing?
So it, again, varies by state. So I'll use Florida as an example. In their process, you only have to buy a lien once, right? And now you've got a position on that, I'll say chain of title, and you eventually, after 22 months, if it goes unpaid, you can start the tax deed application process in Florida. That eventually culminates in the auction of the property, right? Somebody else can buy the property. That is in Florida. On the flip side, right, New Jersey is a state where you have to pay all of the subsequents to maintain that position. And so in New Jersey, you're paying 3 years of taxes right before you can start that process. And so those are kind of difference, from state to state. Sometimes you don't have to pay every year, and sometimes you have to pay every year, just depending on the state.
So from your experience, tell us that too, please. How does that work? The calculation, because if you're purchasing the tax lien, so it's covered for, you said, 1 year or 3 years, depending upon the state. So what does that process look like? So it's not like that somebody's missing on the taxes, you pay for the 1 month thing and you're kind of done as a purchaser. Because I was just thinking that it's going to incur every month, right? So that's what I was trying to wrap my head around it. But you mentioned it could be anywhere 1 to 3 years. So how does that process look like if you can walk us through?
So from a return standpoint, right? If I'm the lien investor, right? What does that look like? And the answer is it's solved, right? How much you're going to make is usually solved by the auction process itself. And so
Mhm.
the sale of those liens, right? The deal between the county and the private investor is handled through an auction process. And an auction process is a little upside down compared to what most people picture, right? It's not a, hey, I'll buy it for 1,000, I'll buy it for 10,000, 20,000. Most of the auctions are opposite, and so they start at an 18% return that you're making on that. And first, bidder says, "I'll take 18," right? Who wouldn't? The next person says, "Well, I'll take 17 and a half," and the next person, "I'll take 15," right? And you're bidding down the interest, right? Until at some point somebody goes, "It's not worth it to make less than 5%." Right, or
Mhm.
whatever that amount is, and it's the lower bidder that wins in that scenario. And that's how that interest rate is determined. Now, again, the reality of it is it's a much more complex situation, because I like to go back to Florida and New Jersey just because those are two fairly popular states, and they have very, very
Mhm.
different processes. Florida uses that auction process I mentioned, right? But if anybody looks at the results in Florida, it's oddly the amount of people that are willing to take what is a 0.25% return. Like they bid down, right, until somebody says, "I'll take a 0.25%." That doesn't make sense to you and I. It doesn't make sense to anybody. Like, why would you take a 0.25% return on top of, in Florida, right? As a lien holder, you won't be the owner of that real estate unless you also go to the tax deed auction and buy the tax deed. So
Mhm.
as it sits, doesn't make sense. Well, Florida has what's called a penalty. So there's a 5% penalty that's added onto that equation. And so if that homeowner redeems tomorrow, then you get an automatic 5%. Well, take that 5% over a day times 365 days. That's an excellent annual return, right? And so there's folks that play what's called the Fast Five game in Florida, where they target liens that they believe are going to redeem very quickly. And so you may not get a ton of interest, right? But when you add up that interest over the course of a year, that annualized return ends up being very good. Now that's Florida, right? New Jersey has a very different process, right? So you're bidding down, right? So that starts there,
Mhm.
but then if you can actually bid down to zero, and then you start bidding what's called a premium. So you bid down to zero, and then somebody steps in and says, "Okay, I'm going to take 0%, and I'm going to give you $1,000, right, to the county." The county says, "You're great. I'm getting more than what I was, originally due." again, doesn't make a whole lot of sense for somebody to say, I'm going to buy a lien for 0%. I'm earning nothing on it, and I'm going to give them money. Like, why does this doesn't make any sense? Well, back to the subsequent of taxes question, you have to pay and you should pay, and you want to pay the subsequent taxes because those are not sold at auction. You get to buy them automatically, and you get 18% on those subsequent taxes. So in New Jersey, it's the exact opposite model, right? You want the taxes to be unpaid for multiple years because every 6 months you get to add another lien at 18%. And so your first one is a loser, right? But 3 years later, if you have 2.5 years of 18% taxes, your blended rate ends up being good, right? It's somewhere between 0 and 18%. But after 2.5 years, it might be 13, 14% rate of return that you're making. So it's a complex model that you're putting in place there. And again, varies by the state of which one you would deploy, but the rate that you will earn, right, varies really by how much you want to make, right, and also where you invest.
So what is the subsequent lien and how does that work? You mentioned that you can get maybe zero or paying out of your pocket the first lien, but
Mm-hmm.
how do you build up on that? Take us through that as well.
And so I guess that's just a term or terminology that we can use in the space, but it's the other taxes that you continuing having to pay on that particular property, right? So back to like in Florida, you can buy 1 year's of taxes and you're in that position, you can start the foreclosure. And in Jersey, you have to pay 3 years of taxes before you have to pay those subsequent taxes. You bought the lien with year one, but if it goes unpaid year two, you have to pay year two and you have to pay year three. And those year two, year three are what we call subsequent taxes.
But it's the same lien, right? Because you're purchasing it for year one and the year two now.
Correct.
That do you get the power to set up the interest rate at that point, or do you have some say in there, or how does that work?
You get what's called the statutory maximum, and so you get the full 18% on those subsequent taxes.
So is it pretty easy process if somebody wants to get into that, or is it like sounds a little bit complicated from my end right now because I'm not that um, acquainted with the process yet.
Yeah. It is complex. Now, mechanically, logistically, it's not hard to get into buy. You don't have to go get a certification. It's not like getting a Series 7 license, right? Anybody, literally anybody that has a social security number or an EIN, right, can set up a bidding account to participate in these auctions. And the county will gladly take your cash for buying, these liens. The hard part, right, is learning how to deploy it the right way, right? Learning the bidding method, the accounting principles, and like what is the game here, right? In each state, the game is slightly different. And then also learning how to underwrite the liens, right? Learning how to decide which ones are actually worth buying and which ones are not, because the county will sell you liens on anything, right? And a lot of it is worth money, and some of it is not. They when you sit down and look at a parcel map and these are sold by the parcel, right? When you look at a parcel map in a county or a city, right? Most of the parcels make sense, right? It's a square, it's a house, and then you have these weird, shaped ones where I've seen literally a chunk of sidewalk, a little triangle piece where a bunch of roads come together, a mailbox I've seen where for whatever reason the mailbox was separated from the rest of the property. The county will glad you sell the liens on those chunks of weird property, and there's really not any value in them. And so in those cases, you've bought worthless, you've made a worthless investment, right? That's money wasted. And so understanding how to underwrite these liens is really challenged on number two. Once you get past the accounting, right? How do I approach this, and how do I bid it at an auction to make sure I'm going to make money?
So let me ask you this question. I think you answered it part of it earlier. You said, if somebody is not paying the taxes, that's how the process gets started. But
Mhm.
fundamentally, I wanted to understand how these opportunities are created and what has to happen for the property to end up in this tax lien situation.
So yeah, I guess it's like why do those property taxes go unpaid, right?
Yeah.
And in many cases, it's I think a chosen. It was like people knowingly like, hey, this bill is due. Either A, don't have the cash to pay it on time, right, and then they figure out how to pay it, shortly after, But I think more often than not, it's an unknown amount that they had never accounted for, right? I think the more common one was they paid a mortgage for 25 years, right? And included in that mortgage payment was a little bit extra every month so that when the taxes were due, the mortgage company would pay your property taxes for you. And so what happens is after that 25, 30 years, right, the mortgage company is no longer paying those property taxes on your behalf, right? And so you get this bill in the mail and you're like, what's this? I've never paid this before. Probably, throw it in the trash.
Mm-hmm.
Well, eventually the county says, okay, well, I'll sell a lien on your house. Now you get a notice that says, hey, you have a lien on your house. You could lose your property. Well, whoa, where did this come from? And so, like most people do, run to the county, pay their property taxes, pay that interest, right, for paying it late, right? The investor's made whole, the county's has their cash all along, the property owner avoids losing their house. And that happens 99.9% of the time. It's
Mm-hmm.
just this unknown bill that has been out there since they bought the house. They just have never actually had to actively pay it. And so it's this weird bill that they get in the mail, and some people just don't think is real. And then the third one, which is a very small fraction too, is I say truly abandoned, right? The For whatever reason, I'll say usually it's after natural disasters. I think I'll use Hurricane Katrina in Louisiana, right? You have a natural disaster, your property is absolutely wrecked. You get an insurance check, and you look at the amount of work on your property, and you go, "Is it worth me?" I mean, I got my cash from the insurance company. Is it worth actually trying to rebuild this house, or do I just go somewhere else, right? And you abandon that property. Well, that property eventually goes through the tax sale process for somebody else to take it over, and nobody pays those property taxes, ends up losing ownership, but it's abandoned. Like the previous owner actively said, I don't want this property anymore, and moved on. And those are the ones that usually make it to a tax deed scenario.
Hmm. And they could be like really, I would say, hidden gems for somebody, right? If somebody's looking at closely. And that makes me wonder, what do you think? Why so many investors go and tire their career without even knowing about this thing, that this exists or this part of the market exists somewhere?
Yes. So yeah, diamonds in the rough, right? Gems in there somewhere. That's definitely the game, if you will, right? But I think it's probably more important to understand, like most of the properties, if you're going to the tax deed auction to buy the assets itself, because there's two very different mentalities, right? Buying tax liens is a very passive model of you're never going to own the real estate. You shouldn't go into it assuming you're going to own the real estate. You're going to earn an interest rate over a period of time,
Mhm.
and that's I'd say a passive mentality versus tax deeds. You're the real estate investor. But the real estate that gets to that point is all value add, right? I mean, if anybody's listening is watched Fix and Flip and Flip and Flop and all those shows on HGTV, and they show the house at the beginning, right? And it's a hoarder's paradise. There's stuff everywhere. It is a horrible looking property on the inside. I guarantee that's probably a tax sale property, and that's the type of asset that you're buying. These are not grade A assets, or properties that you're going to want to live in day one, but they're amazing opportunities if you like putting in the work, right, and adding that value and fixing that property, and ultimately turning it from probably the worst house on the street to one of the best houses in the street, or on the street in that process, and you get rewarded for that. And so there's a lot of work involved on the deed side versus the lien side.
Hmm. So, I think like we were chatting earlier before the recording, you mentioned that you come from a systems engineering background. When you first look at the space, what did you see that others didn't see? Because, coming from a systems background, you'll be like, I would think more like, the IT person or working for a corporation, and then why tax liens?
Yeah, yes, I guess. Why the heck did I ever get into this space? Which I've asked myself that exact question many times, at least once a year, Vicky. But you know, as an engineer, I like to solve problems, right? And when I found out about tax liens, which is really on the wrong side, I was fixing and flipping properties, ended up with a tax lien on one of my houses, and that's how I was introduced to this whole concept. But when we started, looking at, oh, hey, this is a real thing. We want to start buying these, liens, and at the time, there was no information that existed that was easy to access, right? Simple questions like, when are these auctions taking place? Where are these auctions taking place? what are the properties associated with this auction, and then what's the information behind those properties, so that I could easily determine which ones I want to buy and which ones I don't. None of that existed, and so it became a challenge, right, to try and plug that gap. Right, initially, I'll say internally, we were just trying to do it for ourselves, and then it was suggested of making it a system that others could access as well. And within a couple of years, the system itself and the revenue associated with it way outgrew, what I was making buying liens on a small scale. And that's how tax sale resources came to be, and then has since grown into, let's say, I'd say the dominant real estate software in our space, right? But we then accumulated a data set that was unique, and then said, hey, maybe we could use that data to go buy tax deeds, targeting those gems, right? Targeting the ones that we knew from data are going to be great winners, right? And can we deploy this on a large scale? And that's really when we started in buying as a fund, right, as Mount Earth Capital. So it started as a challenge, right? As hey, I see a problem, I want to fix it. That engineering mentality, and turn into a pretty lucrative business, and then eventually a more lucrative fund that we operate today.
So how do you find these gems? That's the number one question. And earlier you mentioned there's some underwriting involved because all the deals are not the good deals.
Right.
So from your experience, share with us, first of all, how to find them. How did you started finding the gems yourself?
Mm-hmm.
And what does the underwriting process look like for this one?
So finding them is much easier today than it used to be, as far as answering those basic questions. So we tax sale resources, compiles data from over 10,000 auctions every year, right? Almost 2 million properties that end up in this state on an annual basis. And so we put all of that in our platform, right? And most people are familiar with Zillow, right? And so think of it as a Zillow, but only for this distressed real estate. So you'll never find these properties on Zillow, but you'll find them in our platform, and it's all the same information like you find on Zillow, right? How big is the property? What is the assessed value? Like all of those data points, right, in order to make that decision. So it's easy through tax sale resources to find those. Now there's some algorithms that we apply, right, as a fund that is unique to target which ones that are out there that we think A, are going to go to auction, and B, sell, right, for the best price. We don't necessarily make that public because that is the proprietary piece of what we deploy as a fund. But at least we've got the platform. Anybody can have their own proprietary model, deploy that through the software, and target the properties that they want to target. And really, when we roll it out, it was a game changer, because before we came about, right, funds, right, people that attend these auctions, they would underwrite every single lien in an auction, and then they'd buy the ones that they can, and then they go to the next auction, underwrite every single lien, buy the ones that they can. And you couldn't really do things like, hey, I only want to buy commercial properties, or I only want to buy bowling alleys, or I only want to buy gas stations, for whatever reason, because they just don't happen that often, right? But with the software, you could say, I want to buy gas stations, and it'll say, well, here's the 10 that are going up for sale next week. Yeah, they are all over the country, but at least you can deploy a model like that today, which you couldn't, 5 to 10 years ago when we got started. That's a long answer to your first question, Vinky, and I think you had another one in there. So which one am I missing?
So first one was how to find it, and then you, I think, linked with the database. I think county or state or city's database where you're pulling the information right into your
Right.
platform. That's the way I understand it. So the part two question was how you underwrite them.
So the underwriting, and so there's two parts to the underwriting, and one part, I think anybody that's familiar with real estate will recognize this, because you're just underwriting the asset, right? What is the value of that asset, right? Is it worth 100,000? Is it worth $500,000, or is it worth zero, right? If it's a mailbox, it's probably worth zero. That's part one. Part two is you're underwriting the title, right? Especially on the tax deed auctions, because the county is not giving you title insurance to these properties. You're buying the deed, and then you have to go figure out how to get title insurance. And usually there's a subsequent process you have to go through called a quiet title. And that quiet title can be easy, right, and be a 30 or 60-day process, or it can be very long and very expensive if it's a dirty title. And what I mean by dirty title is things that can be on there where it was sold through probate, and there's like 10 errors on there. Those are all people you have to find and notify, right, of this sale taking place. And so when you're underwriting the title, that's a very different underwriting style than I think most real estate investors are used to, because you're used to closing through a title company. The title company does all that work, and you get title insurance. You don't need to know any of that underwriting piece. But when you're buying tax deeds, you definitely need to understand the underwriting piece for title as well. So it's 50-50, right? 50% asset underwriting, normal, right? And 50% title underwriting, not normal.
So when you're underwriting the property itself, what assumptions you're making?
So a lot, I guess, is the short answer, because you don't have interior access to these properties. You're making assumptions based on, I'll say, drive-by inspections, right? Exterior pictures, right? And I'd say, don't ever anybody go buy these, based on what Google drive-by, view says, because more often than not, that Google drive-by is a year or two old, and a lot can change on an abandoned property in 2 years. But you have to make assumptions of, okay, what does the exterior look like? Okay, based on that, is the interior has to be somewhat similar, and so you're discounting the value compared to what a normal comparable property would be, because the normal comparable properties are livable and most tax deed properties are not. And I'd say in most cases that's a safe assumption. Interior and exterior are going to be in similar condition, but we've certainly been burned. We bought enough of these where outside looked great, right? You get inside and somebody had already stripped it down to the studs, and so that value, right? We were underwater on that particular property. Luckily, we buy enough winners to offset those few losers, but you are making a lot of assumptions. Now, the good part of those assumptions is rarely, right, people are buying these at full market value because of that risk, and so you can get great deals, right? We average buying properties at 55-60 cents on the dollar, right? Because we know which ones to target, we know which areas to target, and so not everybody has that advantage, but you can still find deals in this space versus normal MLS listings today. Good luck getting anything more than a 10% discount.
Wow, that seems like very complicated due diligence process. And my question was like, it's just like circling in my mind, how do I differentiate between the good and bad?
Mm-hmm.
Is this easier to look at that way? Or, okay, I can say, okay, I can weed out all this, it does not make sense to me.
Yeah,
What
I
are
think
the some, go ahead.
the heart with good and bad is it truly is a one man's trash is another man's treasure in this space.
Mhm.
And so if you're for those that are looking for grade A single family houses that they think they're gonna buy those at scale, well, you're gonna find that's very, very rare in this space. And versus folks that target I'll say infill vacant lots, and most people would want to avoid those, right? But if you have a business model that allows you to make a good profit from buying and selling those infill vacant lots, well, then there's a ton of those in this space. And so it really is just defining what your model is, right? And it's going to have to be different than what everybody else is doing in order to get that competitive edge, in order to get away from the demand that's out there, because everybody wants that grade A property at 60 cents on the dollar. Who wouldn't, right? So does everyone
Mhm.
else.
Great. So let's talk about risk from a real perspective. Where do investors actually look at it, I would think, or how do they get into trouble in this kind of space? That's what I wanted to know, what could go wrong basically.
Well, the number one risk that I mentioned before is buying liens on worthless property, right? And so you can certainly go buy a lien on that mailbox, and you can buy that lien for a couple $100s, right? But it's unlikely that anybody's ever going to pay the property taxes on that mailbox. And what are you going to do with that mailbox, right? You're actually going to go spend a couple $1,000s going through a foreclosure on that mailbox, and then how are you going to sell that mailbox, right? So it's the very easiest thing to do, right, to avoid that risk is just learning how to underwrite the properties. Beyond that, there's a ton of other ways, right, that you could, right, but they happen very, very rarely, right. And so
Mhm.
if you underwrite a property at a tax deed auction and and it has 10 or 15 errors on it, right? You're going to spend $30,000 on that quiet title action versus $3,000 on that quiet title action. And those are scenarios that could happen, and there's probably thousands of other of those weird scenarios that could happen. But if you just underwrite the asset right from a title perspective and from a asset perspective, right, well, you're not going to be perfect, but if you underwrite it well, then your risk goes down enormously, right? Because you got to keep in mind, if you're buying a lien, your lien has superior position over mortgages, right? And so your risk there is dramatically lower, right? And if you're buying these tax deeds, again, they've gone through a foreclosure. As long as you've done your underwriting, right, your risk goes down immensely. And so, not to say there is no risk, right? There is a lot of risk if you do know underwriting, and that risk is substantially dropped, right, if you do some underwriting.
So your software does the underwriting too, or provide the tools for underwriting?
It is the tool to use for underwriting, right? So it gives you all the information, right? We don't go through and automatically say this one's worth buying, this one's not, right? Because it's definitely it might not be worth buying to you, but maybe to somebody else. So we don't make the determination, but we give you all of the information for you to make that determination yourself.
So now with AI coming into picture, you think your model is gonna get even better, or people can use just the AI tools to evaluate the deals, complete their due diligence, or maybe underwrite the deals too, so somewhat, if they know a little bit, what kind of assumptions, what to look for.
Mm-hmm. Yes, I mean we are using AI, right, to help us underwrite properties, right? It's not where you can go to ChatGPT today and say, hey, tell me which liens in this upcoming auctions are worth buying. It'd probably give you an answer, but I would not trust that answer today. But you can do things of a, hey, underwrite these 10 parcels based on these features that I care about, right? And it'll give you a much more informed answer on those scenarios, which used to have to pay people, a lot of salary in order to get to those decisions. So it is certainly can be a game changer if used in the right way.
Mhm. Interesting. So the next question comes to my mind is, who this is really for, is this a strategy better suited for active investors or passive investors or both?
So yes, you can. Tax liens are much more passive, right? Not entirely passive, as like buying a stock and then you can forget about
Mhm.
it, right? It's less risk than buying most stocks, but it's certainly not as active as buying real estate, right? And tax deeds is a much more active, investment, much more risk, right? But also the reward is typically much higher on the tax deed side. So if you're active, right, you're a real estate investor and you're just looking for another avenue of buying properties at a discount, then tax deeds can be, a solution for you. But if you're looking for that passive investment, then I would stick with the tax liens, with I'd say exceptions, right? There's actually some funds in the tax lien space. And so if you want to participate in tax liens, but don't necessarily want to do all that work, that passive investment is still a little too active for you. You can connect with one of those funds and participate in their structure. And then our fund is actually for accredited, it's 506c fund for accredited investors. So you can participate in tax deeds from a more passive standpoint as well. Downside is you do have to be accredited in order to participate with us.
So this could be, you think, one of the wealth building strategy?
Well, I will, obviously I'm biased, but it has certainly worked well for me and us, right? Of once we got into the space and learned what we do very well and have deployed that, we've done very well. But it certainly is not for everybody that wants to do this in their spare time.
Yeah, but the thing is, you are the fund manager for in this space, right? So you do have a fund, and then you offer to other people to invest alongside you. So
Correct.
it could be a passive investing for somebody, and could be like I would say a small percentage, if allocated, could be part of their wealth building strategies, one of the strategies. So what I wanted to understand from you is, can you give us kind of ballpark idea what kind of returns people get from your fund if they invest with you?
Well, so our fund is structured as it's a note structure, and so folks are getting a 16% annualized return, paid out quarterly. I'd say that's on the upper end. Depending on how much is invested, it's from 12 to 16%, but the high end is that 16%. And then the funds are locked up for 2 years. So for 2 years, you have no liquidity. After 2 years, you have the option of getting your capital back out, right, or rolling it over and keeping it earning for you for another 2-year period. And that's how our fund is structured.
Wow, that's really good. Oh my God, I have so many more questions, but we are way over time. So let me ask you one last question. So when you zoom out, what role do you see this space playing in the future real estate investing?
Well, it's right now, tax liens, tax deeds aren't going anywhere. They've certainly evolved through a few Supreme Court cases recently, but they're not going anywhere, and they're countercyclical. So when economies are we're in a recession, then usually there's more tax liens, tax deeds out there, and a better deal that you can get at these auctions. So it's an interesting. I don't know. I always feel bad because I'm not necessarily rooting for a recession, but we do better in a recession, for what that's worth. Now, I'll caveat that with, in recent years, there's been a skyrocket of real estate value and a skyrocket of real estate taxes that came with that. And because of that, there's actually 2 states right now that are petitioning to potentially eliminate property taxes. And so, if that were ever approved, we don't foresee that actually going into effect, because it's a massive impact to local communities, right? Back to those counties and who what they do with that money, right? If they didn't have that, well, that money's got to come from somewhere, right? Roads got to be paved, teachers got to be paid. So without some alternative solution, what options do you have? You don't. But there's talk today, which this never existed 10 years ago, but there's talk today about eliminating property taxes, which would be detrimental, at least to the space. So it'll be, I don't know, interesting to kind of watch how that evolves.
Interesting. Wow. So this brings us to our rapid fire round. I'm going to ask you 5 questions, all spontaneous answers, no overthinking. Answer should be 1 word or 1 sentence only. Are you
Ooh,
ready?
I'm ready.
Okay, perfect. The first question is, what's one habit that helped you stay sharp as an investor?
Learning, right? I'd say have an insatiable appetite for learning. I'm always listening to a book or two, and because of that, I get exposed to a lot of ideas and I don't know, just solutions to things that I'm not smart enough to come up with. So let somebody else come up with those, and we can implement them.
I think I really like that strategy, learning from others' experience, and we learn the best just being the human beings. So the next question is, are you more focused in the morning or at late night?
Oh, I'm a morning person, 100%. I'm get up at 5 and go to bed at 9:30. If I could have my way every day. Sometimes it goes beyond 9:30, but that'd be my preference.
One place you go to think clearly and reset.
I love the outdoors. I grew up in Montana, so anytime I can get on a trail outside, I'm thinking the most clearly ever.
One piece of advice you'll give to someone who thinks he or she is stuck.
Don't give up. Persevere, right? The answer is out there, especially if you're willing to investigate and give it time. The answer seems to always arise.
I like that. Don't give up. That's the best strategy. So, last question. What is your wealth vibe?
My wealth, it's a broad question. I think my wealth vibe is one of I try to embody this book that I listened to called Die with Zero, which is not literally die with $0, but it's try to be conscious of the time that you spend building that wealth, and then what are you going to do with that wealth? And I don't want to be one that spends my entire life building wealth, and then at the end of the day, not can't do anything with it, right? And what did you spend your whole life doing? And so I'd say responsible wealth accumulation and responsible utilization of that wealth, right, in ways that benefit family, community, right, and ultimately the world.
Great, awesome. This is such a powerful conversation, Brian. So, where can our listeners connect with you to learn more about you and your fund? I know we ran out of time. I wanted to ask you more about your fund. We never got to it, but share your information, how people can reach out to you.
Yes. Well, I guess if you want to learn more about the platform, just go to taxsaleresources.com. If you want to learn more about our fund, go to mountnorthcapital.com. Those would be the two easiest ways.
Thanks again, Brian. And if there's one thing to take away from this conversation is this, the biggest opportunity in any market are rarely that most visible to everyone. They exist in gaps where few people are looking, where information is not evenly distributed, and where understanding creates advantage. What Brian has shown us today is that building wealth is not just about working harder or chasing more deals, it's about seeing differently. And I think that's what he did, being a systems engineering and stepping into tax liens. What a great journey. And once again, thanks, Brian. And to everyone who's listening, stay inspired, stay intentional, and keep building your wealth vibe.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.